Gen Z's credit health is slipping faster than any other age group. A new FICO report shows the U.S. average credit score fell 2 points to 715 this year, but Gen Z dropped 3 points to 676, the biggest annual decline since 2020. Analysts blame the return of student loan delinquency reporting. 34% of Gen Z hold student loans, double the national average, making timely payments critical to protect their credit. Gen Z faces the sharpest credit hit in years. FICO says the U.S. average score slipped to 715, but Gen Z dropped to 676, with 14% seeing a 50-point plunge. The main culprit is the return of student loan delinquency reporting after pandemic relief ended in late 2024. Because many lenders use credit scores, 300 to 850, to approve mortgages, car loans, and credit cards, experts urge on-time payments and careful account management to avoid further damage. Gen Z's credit scores are falling faster than any other group. FICO reports a drop to 676, down 3 points in a year, with 14% seeing 50-point plunges. About 34% carry student loans, and as federal payment relief ended in late 2024, missed payments now drag scores lower. The New York Fed warns late borrowers face steep penalties, and Gen Z's shorter credit histories make them more volatile. Nationally, the average score slipped from 718 to 715, while Wallet Hub ranks South Burlington, Vermont highest at 701 and Detroit lowest at 566. Gen Z faces mounting financial pressure as student debt, a soft job market, and high inflation lead to more missed payments and lower credit scores. FICO says their average score fell to 676, making loans, credit cards, and even auto insurance costlier or harder to get. Experts note that shorter credit histories magnify the damage, yet also give Gen Z the most room to rebuild by paying on time, reducing balances, and steadily lengthening their credit record. Gen Z's credit scores are sliding amid stubborn inflation, high interest rates, and a tough job market. FICO's report shows their average score at 676, as many lack savings and have missed out on stock market and housing gains. Experts call it a K-shaped economy, where wealthier households thrive while others face rising costs. Analysts warn poor credit can add tens of thousands in interest and fees, but say Gen Z's youth gives them time to rebuild by paying on time and cutting debt. Gen Z's credit scores have dropped to an average of 676 as student debt, high inflation, and steep interest rates squeeze budgets. Experts warn that poor credit makes borrowing and even insurance far more expensive, but rebuilding is possible. First, know your number. Check it regularly with free tools like Experian, FICO, or Credit Karma. Then act, pay every bill on time, lower balances, and build a longer credit history. Your score matters for loans and housing, but, as advocates stress, it's only a financial metric, not a measure of personal worth. Gen Z's average credit score has slipped to 676, but experts stress it's fixable with smart habits. Key steps: pay on time. Payment history makes up about 35% of a FICO score. Set up automatic payments so you never miss a due date. Watch utilization. Use only 10 to 30% of your available credit. Too high hurts your score, but 0% shows no activity. Avoid new debt. Focus on paying down what you already owe. Because FICO scores update with your behavior, consistent on-time payments and balanced usage can steadily raise your score and cut borrowing costs.